Have you ever wondered if you're claiming every tax deduction that your business is entitled to? Well, stay tuned because in this video, I will share everything you need to know about tax deductions, including real-world examples to help you think through the process. The IRS defines a tax-deductible expense as any business expenses that are ordinary and necessary cost of carrying on a trade or business for the purpose of generating a profit. And I want you to notice that there are three main ideas in this definition. Ordinary and necessary, primarily for your business, so not at all for your personal, and it's likely to generate a profit. The payment that's leaving your bank account needs to make sure that it checks all three of the boxes to be considered a tax deduction. So it's got to be ordinary, necessary, primarily for your business, likely to generate a profit. So here's an example. If you buy a boat for your business, is it tax deductible? Well, it depends on the type of business that you own. A boat is not a tax deduction for an air conditioning company or a plumbing company where the service is primarily performed in the customer's home. It would be hard to make the argument that a boat is ordinary and necessary and that it's likely to generate a profit. But what if you are a real estate agent and you primarily sold real estate on a lake? Would a boat be tax deductible? One of the best ways to sell real estate on the lake is from the boat. You're able to move between the properties a whole lot faster. It's more comfortable for your clients, and sometimes the best side of the house is viewed from the lake. So yes, a boat may be tax deductible for a real estate agent that sells property on the lake. Well, maybe at least part of it, probably not 100%. So what do you think about an airplane? Is an airplane tax deductible? You're right. You're catching on very quickly. It depends. If you own a business that serves customers within a 30-mile radius of your office, it's highly unlikely that an airplane will be considered ordinary and necessary. And if you've ever seen how expensive airplanes are, then you know it's highly likely to not generate a profit. But what if you owned a construction company and you had job sites all over the country? You and your project managers visited the job sites on a regular basis. When you consider your time and your money, it might be beneficial to own a plane, because owning a plane may give you the ability to take on more projects, leading to more efficiency and the ability to generate more profit. Notice how the answer is not always no. For some businesses, the expense may be a tax deduction, but for others, it may not. Let's say that you are traveling on a business trip and you're turning it into a family vacation. Can you claim the entire trip as a tax deduction? No, the entire amount is not tax deductible. You can claim the expenses that you would have spent if you traveled by yourself for the business trip. The additional family expenses are not tax deductible. Look at each expense separately. For example, the registration for the business conference, yes, it is tax deductible. The airplane ticket, your ticket is tax deductible, but your family's ticket cost is not. The hotel and the rental car, it is usually tax deductible unless you add a significant amount of days to the trip that would not have been included with a business conference. If you take your family to an amusement park, it is unlikely you'll be able to claim that as a tax deduction. The trick is to review each expense and ask yourself if the expense checks all three boxes that we've got listed up at the top of the screen. What if you own a wedding planning company and your daughter's getting married? Would the entire wedding be tax deductible? No, it's not going to be tax deductible. This is not ordinary and necessary for running a wedding planning business. And I don't care what type of clientele you're inviting to the wedding. There's no way it's primarily for business purposes. It is for your daughters and your family to celebrate this happy event. So no, the entire amount would not be tax deductible. But what if you hired a videographer that recorded extra footage for you to use on your social media or your new website? it is possible that you could claim a tax deduction for some of that extra footage that you paid specifically for business purposes. What about clothing? This is a really common tax deduction question. Clothing is tax deductible if it meets two criteria. It must meet both of these. It is required for work, and you would never wear it to a party. So this rules out suits and business casual outfits. They are not usually tax deductible. Clothing with your logo and clothing required for your industry, like medical scrubs, cargo pants, steel-toed shoes, those would be tax deductible. Learning the different tax rules can be time-consuming and confusing. One of the tests that I rely on is the laugh test. Imagine sitting across the table from an IRS agent when you're explaining the tax deduction. Would you be able to keep a straight face, or would you giggle and smirk just a little bit? Would you be able to give the IRS agent clear evidence of why you should be able to claim this as a tax deduction? Once upon a time, there was a tax accountant that bought a boat for his tax practice, and he claimed the full amount as a tax deduction. The accountant named the boat 1040 after the famous IRS tax form. The accountant made the argument that because he named it 1040, the cost of the boat was a legitimate tax deduction. So what do you think? Is naming a boat after a tax form enough to claim the tax deduction? You're right, it's not. The IRS denied the tax deduction, and I'm sure that tax accountant paid just a little bit extra in penalties and interest as well. As you can see, most expenses are tax deductible as long as they meet the three criteria set in motion by the IRS. Some tax deductions are allowed, but they are limited. For example, meals and entertainment, it is often limited to 50% depending on the tax year. Some tax years allow up to 100%, but for the most part, they're limited to 50%. Also, keep in mind, gifts are limited to $25 per person per year. Some expenses are tax deductible, but they're listed separately on your tax return. The two most common are charitable contributions and your owner's health insurance premiums. Some expenses are a cost of doing business, and they should be included on your operational financial report, but they are not tax deductible. Here's some examples. Your owner's pay. If you are a sole proprietor, LLC, or partnership, owner's pay is not tax deductible. Income taxes are not tax deductible for sole proprietors, LLCs, partnerships, or S corporations. Here's a little side note. Owner's pay, income taxes, they might not be tax deductible for your business depending on your tax structure, but they are definitely a cost of doing business. That means that you need to consider that cost when you are calculating true profitability on your financial reports, when you're projecting cash flow, and you're setting your prices, because it's got to be considered in order for you to have the money when you need to pay those. Also not tax deductible are fines and penalties, life insurance for the officers of the business, and political contributions. Personal expenses, they are never tax deductible. When it comes to tax deductions, the IRS requires businesses to use a record-keeping method that clearly and accurately reflects your gross income and the expenses. The IRS requires that you track your expenses in a way that you can easily identify the payee, the amount that was paid, proof of payment, the date, and then also a description that helps prove that the expense was a legitimate business expense. You must be able to prove two things: what the expense was for, so that way you can support the business use, and you need to also confirm that the expense was in fact paid or incurred by the business. So when you're thinking about what type of documents you need to keep, a lot of business owners think that they simply need to keep the bank statement and the credit card statements. But keep in mind that this only confirms one piece of that puzzle, that the expense was paid or incurred. But we've got two things that we've got to prove. And we're going to need the actual bill, the invoice, and the credit card receipt to actually support the other piece of the puzzle, what the expenses were for. You need the credit card receipt to support the credit card statement. You'll also need the bank statement to confirm that the credit card was paid by the business account. You also may need the actual invoice from the vendor depending on how much detail is included on the credit card receipt. So it's quite possible that you need all 4 documents to support just one expense for your business. Have you ever been surprised by how much you owe at tax time and wonder, have I claimed every single tax deduction that I'm entitled to? Well, one of the easiest ways to confirm that you've claimed everything is to do a quick comparison between your financial report and your tax return. Compare the bottom line on your profit and loss statement to the taxable income on the tax return. If there's a big discrepancy between the numbers, ask your tax accountant to explain the difference. If your tax accountant tells you that the expense is not tax deductible, ask them for more information so that way you can learn more about what is tax deductible. Because in most cases, if your business legitimately needs it to operate, it should be tax deductible. The bottom line for tax deduction is the burden of proof is on you. The tax court system is very different than the criminal courts. In a criminal court case, the law states the burden of proof is on the government to prove beyond a reasonable doubt that you did something wrong. In the tax courts, it's the complete opposite. It's 100% on you, the taxpayer, to prove the tax deduction was a legitimate business expense. The IRS also requires that you maintain accurate records that clearly show income and expenses. You are ultimately responsible. You must take ownership of the tax process. Not that you're going to do the bookkeeping, not that you're going to prepare the tax return, but you're the one ultimately responsible for paying the tax, agreeing with what's in the tax return, and signing that tax return. Thank you so much for watching. If you enjoyed this video, please like, share, and subscribe to my channel.